To determine the WACC, we need inputs for the cost of debt, KD, and the cost of equity, KE. The cost of debt reflects the fixed interest securities yield to maturity. It can be a complex rate to calculate, especially if the debt has a maturity greater than 1 year. This rate is often provided, but it can be calculated if we have the bond's current market price and other inputs to the bond pricing formula. We can rearrange the formula to solve for the cost of debt. So, for a 1-year bond with a coupon of $15,000, face value of $260,000, and market price of $250,000, we can calculate the yield to maturity. In this case, the yield to maturity, or cost of debt, is 10%. The cost of debt is typically provided on a before-tax basis. However, interest on debt is typically tax deductible, and so this reduces the cost of funding to the organisation. As such, we can also calculate the after-tax cost of debt by applying the tax rate. So after-tax cost of debt equals the pre-tax cost of debt multiplied by 1 minus tau, where tau is the relevant tax rate. Using a tax rate of 30%, we can therefore calculate an after-tax cost of debt of 7%. The required return is largely affected by the riskiness associated with an investment. As a funding provider, equity or ordinary shares has a higher risk than debt, as dividends are not guaranteed and capital repayments may not eventuate. And hence equity has a higher required rate of return, therefore, typically, the cost of equity is greater than the cost of debt. The cost of equity can be calculated using CAPM, the Capital Asset Pricing Model. This model suggests that the required return for equity holders is the summation of the risk-free return, such as from government bonds, plus a risk premium to compensate for the possibility that funds may not be repaid. In CAPM, RF is the risk-free return. ERM is the expected return of the market portfolio, and beta is the systematic risk of a particular security. It is also worth noting that ERM minus RF is the expected market risk premium. That is, the differential between the market return and the risk-free rate. So let's assume that the risk-free rate is 4%, the expected market return is 15%, and the systematic risk of a security is 1.1. We can firstly calculate the expected market risk premium. Next, we can calculate the overall risk premium. We can now add the risk premium to the risk-free return to calculate the cost of equity capital, which is 16.1%. We now have both the cost of debt and the cost of equity, and we can apply these to the WACC formula. The important thing to remember is that the cost of debt reflects the bond's yield to maturity, and the cost of equity reflects the risk-free rate plus a risk premium.